Oh, hi. Are you one of the 90% of retail investors that don't outperform the S&P 500 every year? Well, in this video, I speak to LWT Trading. LWT Trading is a YouTuber, millionaire, and an economist who arrogantly proclaims that it's easy to beat the market and gives me some of the tips why. I am 𝗟𝗍𝗁𝗍𝗁. I've been trading 8 years, and on this channel, my goal is to, one, share what I've learned, but also to talk to other investors and gather knowledge to share with all of you guys. So if you enjoy this video, please like and subscribe.
You know, there's a famous sort of speech with Warren Buffett just on this, just to give some premise to the people viewing. 99.99% of investors should be buying ETFs. And for clarity, about maybe just over, if not around about from time to time, 50% of my portfolio is in ETFs.
Right.
Total net worth, throwing figures out again here, maybe 30-40% total is in stocks and ETFs. So to give you a clue, property, businesses, so on, cash flows, and so on. So it's not going to make or break me. I think most people should at least start in ETFs. But I actually think the more time goes on, I'm encouraging people to continue investing in ETFs, but don't be afraid to do 5% in stocks, then 10%, and get exposure and learn. Because the biggest misconception, like, you know, we'll probably talk about Stock MVP, the software we created, but the biggest misconception is it's hard to beat the market. Now, I think it's quite easy to beat the market, which sounds arrogant. It might be against the grain. It really is. If you watch my YouTube channel, you'll know I'm very much against. I was the person saying the market's going to crash from 2020, by the way. You know, I was calling this way ahead. I was calling AMC crash, Bed Bath & Beyond, all of these stocks. I said, be careful, they're going to crash and burn. And I was the one laughed at. And now I'm probably one of the few people saying, now's the time to start buying. Let me put it in a way. If humans have a bias, I can't remember who said this. I want to say Munesh Prabrai said this, but it might be wrong. And he said humans have a time bias, a recency bias as well. So, for example, let's say you go to a new restaurant in your town, right? It cost you an arm and a leg.
Yep.
But you had an okay time, better than average. Yep. The next time you see a friend and they mention that restaurant, you're going to say it was amazing.
Right.
Because you've been there, you have that experience, right? If you're with Direct Line car insurance, as an example, you're going to say to your friends, naturally, here's who I use, you should check them out. Knowing fine well, there's probably a better deal out there. It's just because you have an experience with it, right? Now, that passes on subconsciously into investing. So let's say you're looking at a stock. Let's say you're looking at, I'm trying to think of a middle, let's say Cineworld.
Yeah.
Right. And it's not to pick on Cineworld, but let's say Cineworld. Now, if you're looking at Cineworld as an example, and you spend 5 hours, you've got to make a decision at some point to say, do I buy it or not? After spending 5 hours, you've got to admit, have I just wasted my time and do I move on to the next stock or not, right? And subconsciously, that's the hardest thing about investing. And that's why we built Stock MVP, is to get a no in seconds with your own cards. So you can instantly go into a stock without looking at the ticker if you didn't want to, and just being, this is shit, right? And it's not saying that, you know, of course you're going to miss the old golden egg and stuff like that, but there's like 88,000 stocks or something ridiculous out there. If you look at all like semi-legitimate markets, how many are you going to own?
But I think also understanding economics is mostly 99% of the purpose of it is to avoid loss. Because well, if I explain, like, for example, a 50% loss on a position requires a 100% gain to get back to where you were. And so if you can look at a business, like, for instance, Tesla, regardless of whether you think that earnings are going to go up enormously, you don't, like, once you understand financials, you understand that all that needs to change is the news around the stock for the price to go down.
Yeah.
Because they don't have the baseline earnings to justify it. Because arguably, you could have a stock out there that's £1 per share and the dividend is £100 per share. Like, that is theoretically possible.
Yeah.
Yeah. And so there's no right share price. Share price could be as low as you like. The share price could fall as much as possible, but eventually there are fundamentals that kick in.
Yeah.
That just can't be ignored.
Tesla, I completely agree with you. I've been one of the Tesla haters, if you want to call that, for a long time. And that's the euphoric point in the market. But again, I come to tell you this is, if you know for a fact 90% of investors, retail investors, institutional investors included, will not beat the market, you need to do what they're not doing. You need to be the 10%. So knowing that subconsciously, if you see everybody rushing into Tesla, what I tell you subconsciously,